Ladies and gentlemen, Greg Michalowski from ForexLive.com. Today's date, May 9, 2015. I'm going to talk about the Aussie versus US dollar and talk about drilling down. Drilling down, what does that mean? Well, let's start off by taking a look at a broader picture. The Aussie versus US dollar, this is a daily chart. And what do you notice here on this daily chart? You got to start seeing these things, folks. What I notice here is a 100-day moving average. I also notice a 50%. That 50% is of this move up from the 2016 low to the 2016 high. Midpoint, 50%, kind of the middle of the seesaw, bullish above, bearish below. Add to that the 100-day moving average, and you've got a pretty good support level, or a pretty good line in the sand, a pretty good risk-defining level. That's what all that means. So traders on Friday, when the market came down to that 100-day moving average, could buy against that level, put a stop below it, and as long as it stayed above, it was more bullish. And indeed it did. The market bounced off of that 100-day moving average, bounced off the 50% retracement level. And now you get into where you're going. Where are you going on that trade? And if I were to look at this chart again and take a look at this area right here, I'm going to put a red line across a high here. And if I take a look at this high, and I take a look at this high, and I take a look at the break above this two swing highs, and I look at this low right here, those are three levels that the market seemed to pay attention to. We came up to it, we went a little bit above it here by a few pips, and the market moved lower, and then we came up to it, we broke through it. Next day we find support, and the market moves higher through here. So that level is a key level that we need to get above and stay above if we're going to move further to the upside in today's trading. And lo and behold, what does the market do? It doesn't get above that line. In fact, we find sellers against that line. The high today came in at 73.84.8. Just to give you an idea, this high came in at 73.84.7. This high came in at 73.81.2. So we're talking about 3 pip difference between this and this right here. And today's high price came right at those levels, right? And it couldn't get above those levels. So guess what traders were doing here on the daily chart? They were selling against that line. As long as the price remained below that line, the price bias remained to the downside. We needed to get back through this key support level here. There's no doubt about that. But there was a battle going on right here as well against that 84, 85 level on the top side. So how was the battle resolved? Well, the battle was resolved by getting below the 50% retrace and getting below the 100-day moving average. And so that's what the daily chart showed. Now let's drill down, take a look at the hourly chart. And if we take a look at the hourly chart, we see a lot of the same thing. Actually, everything off of the hourly chart kind of came off the daily chart. We knew our 84, 85 level up here at the top. We knew our 100-day moving average, and I have the overlay of the 100-day moving average on this chart. And on Friday, non-farm payroll came out, the market moved down, tested that support level. We know market buyers came in, pushed it up to the 84 level, moved down. But we don't know off of the daily chart that we know on the hourly chart is that we did have another trade here, another trade against the 100-day moving average. And the market tried to move higher here, but what did it run into? It ran into resistance against this trend line. And so the market couldn't get above that trend line. We couldn't even get to the 84 level the second time here because we couldn't get above the trend line. And so by drilling down into the hourly chart, we have a new vision of more bearishness through here. And lo and behold, what did the market do? It went below the 100-day moving average, and we know that the 50% retracement level is there as well. And the next bar, what did the market do? The market found sellers against that level. You can see the high price came right up to that 100-day moving average and moved to the downside. So how would you characterize the market right now? More bearish. As long as the price remains below the 100-day moving average, this picture right here is pretty clear. Came down, went up to the 84, held the trend line, moved below the 100-day moving average, 50% retracement. As long as we stay below that level, we're going lower. So the line in the sand is now back at the 100-day moving average. Risk is if the price moves back above that level. All right. So let's drill down a little bit more, just for giggles. And this is what drilling down does. And look at the 5-minute chart. And if we look at the 5-minute chart, we know things from the daily chart about the 84, 85 level right up here. That's this area right here. And I also put in another lower line here around the 81. And why is that? Because we had a low here at 81. We broke through it. We kind of used that level. Here's the non-farm payrolls garbage. And then we came up to toward the 81 level, 85. You can see how the 81 to 85 level became more of the ceiling. So it was a little wider than the 84 level on the top. What else do we notice here on this chart? Well, if we drill down and look at the moving averages here on this chart, the blue line represents 100 bar moving average, green bar represents the 200 bar moving average on the 5-minute chart. And during the Asian session and a little bit of the London maybe, the market or European session, the market was holding support against those levels there, against those 100 and 200 bar moving averages there. You can see it. Everyone can see in the chart. We also have this trend line cutting across here. And lo and behold, when the price moved below the moving averages right here, what did the bias turn to? It turned more negative. It turned more bearish here. So even on the 5-minute chart, it was showing that bearishness, okay? It was given a clue. You can drill down and give it a look at it. We bounced off our 100-day moving average, that's right here. And where do we find resistance? Right against the 100 and 200 bar moving average. That was a trend line as well, the trend line from the top on the hourly chart, wasn't it? So not only do we have resistance right here against the trend line, this is a bounce off the 100 and the trend line right here. If we go to the 5-minute chart, we had resistance against what? Our 100 and 200 bar moving average. And so there's a couple reasons on two different charts showing two different things why there was decent resistance at that level, and the price has indeed moved to the downside, moved back below our 100-day moving average, held that resistance, and keeping below this level. That's the name of the game. So drill down, folks. Drill down and see the picture and the story coming to life in front of your own eyes. And you'll find that you have a better trade location and more confidence in your trading. If you like this video, be sure to click the thumbs up in the YouTube. If you don't like it, click the thumbs down. If you want to share it on their social media. We'd love for you to do that. If you want to subscribe to our YouTube channel, click on the subscribe button. Finally, if you want to be included in our email list, click on the box on the bottom of this post here on Forex Live, and we will include you on our email list. We're starting to send out more emails with these videos and such, so you can look at them and have them stored and easy enough for you to see from forexlive.com. My name is Greg Michael Oski. Hope you learned a lot from drilling down. Good fortune with the trading. Bye-bye now.